In this video, we're going to talk about how bonds work. Now, bonds represent a form of long-term debt that is issued by a corporation or government. They're commonly referred to as an IOU. And so how a bond works is that you have a bond issuer, right? This is the person that actually issues the bond and specifies the terms of obtaining the bond. And then you also have the bond holder. And this is the individual that will go ahead and purchase the bond, given the terms and if they find them to be somewhat agreeable. And so what happens is there's an exchange that takes place, right? For the bondholder, they're giving up money. They're agreeing to commit certain financial resources to the bond issuer, right? And remember, this is basically a way for companies and governments to raise money. And so the bondholder is going to commit financial resources. They're going to give the bond issuer money so they can use that for various things. Now, in return, the bond issuer, at a specific point in time, is going to repay that money, and usually with interest. So we know because of the time value of money, that money usually decreases in value over time. And so what happens is if we're going to incur risk and we have opportunity costs and inflation and those other things, we need to be compensated for incurring those. And so it's only fair that we receive higher than originally we provided to the bond issuer. And so that's kind of just the relationship there and how the two parties work together to get to an outcome that is beneficial to both, right? The bondholder doesn't have necessarily a use for the money now. They want to generate more. The bond issuer needs access to money so they can, purchase equipment or do various things, whatever they find necessary and appropriate to use for that particular set of funds. So bonds have a couple of different characteristics. The first one is that all bonds have what we call a maturity date. All bonds also have what we call a par value. So, first off, the maturity date is the date the bond is basically due. So on this date, the bond issuer has to pay back the bondholder for what we call the par value. The par value is usually specified. It's like the face value of the bond. This is what the bondholder receives at maturity. Now, this isn't always the purchase price of what the bondholder paid to obtain the bond, but this is what they receive at the maturity period. And so at a specific due date, right, i.e. maturity date, the bondholder is going to receive this par value. And let's just say, for example, that the par value is $1,000. So at the maturity date, the bondholder is going to receive $1,000, which is great. Now, there's a couple of other things that we need to know. Now, this is what we receive as a bondholder. This isn't what we pay, right? The payment, what we paid to actually purchase this bond, is what we call the market value, which is the purchase price of the bond. And you can purchase bonds at a number of different prices, but we have a few different categories based upon how much you pay. And so first, we have purchasing a bond, what we call at par. And this means that you purchase the bond for the par value. And so in our example, we have a bond with $1,000 par value. That's what we're going to receive at the maturity date. And we purchased it at par. And so we're basically putting in $1,000. And at the maturity date, we get back $1,000. Now, before you think that this sounds like a horrible investment, because really at this point it is, there also is that interest that we receive. And so that has to be included. We'll get to that in a couple minutes. Now, you can also purchase a bond at a discount, which means you purchase it for less than the par value. So let's just say that we pay $900 and the par value is going to be $1,000. Right? This is what we're getting in the future right here, and this is what we're paying up front. So it's a discount because we're buying it for less than the par value. Now the other option is we can pay a premium or purchase a bond at a premium, in which case we would pay more than the par value. So let's say we pay $1,100 and our par value is $1,000. And so we are paying more and we're getting less at the maturity date. And these are usually reflective of market conditions like supply and demand. So if a bond is in very, very low supply, it's in great demand, you may end up purchasing it at a premium to obtain it if it's maybe a risk-free investment of some kind, if it's almost guaranteed, right? Nothing is guaranteed, but almost guaranteed. You might pay a little more. On the other side, if it's basically not in great demand, if there's a great amount of supply of the bond, then you might be able to purchase it at a discount. And so those are some things that will affect the purchase price, but those are a little different than what you receive, i.e. the par value. So now we mentioned that obviously purchasing a bond at par may not sound like a really good investment, right? Because you're paying in $1,000, you're getting $1,000. It doesn't take a financial wizard to figure out this isn't really working out for me. And so what happens is the bond issuer does something to sweeten the deal. They also put in what we call a coupon rate, or a coupon, I should say. And the reason they call them coupons is that the old bonds, this is many, many years ago, they would have these little tabs of paper kind of hanging from the bottom of them, and you would actually tear those off. They called those coupons, and you would take those in to actually redeem the coupon for your bond and basically get paid for your interest at a specific point in time. And so that's why they call them coupons. Now, the coupon rate is the interest payment that you receive. And the coupon rate is expressed as a percentage of the par value. So let's say, for example, that I have a coupon rate on my particular bond that I am offering of 10%. And our par value is, remember, still $1,000. And so you know that you're going to be generating $100 on an annual basis. And so that is essentially the interest you receive. That is your compensation for incurring risk associated with inflation, opportunity costs, all those different things, right? The time value of money. That is what you get in return. Now, usually that $100 that we're receiving is 2 payments a year. So it's semi-annual payments. It's not one payment every year. So you'd get $50 in the first 6 months, then $50 in the second 6 months. And then when the bond returns, or when the bond matures rather, assuming you have a par value of $1,000, you would get that payment back at the maturity date. Now, the coupon rate isn't necessarily your yield, right? That's what we call a bond yield. So let's express current bond yield. And the current yield is actually what you get. It's kind of your return on investment, if you will. And this is actually expressed as a percentage of the market value. Remember, just because I'm receiving a 10% coupon rate of a bond of $1,000, that's not my return, because that doesn't mean that I paid $1,000 to buy in. Remember, I could have purchased the bond at a discount. I could have purchased the bond at a premium. So let's say I have a coupon rate of 10%. It's still a $1,000 par value, right? So I get $100 every year. And that is my interest. But what I paid for the bond is different, right? Let's say I paid $900 for the bond. Well, in that case, my current yield is actually something like 11.1%. That's what I receive on the bond, because it's based upon my buy-in and not on this par value over here. Now, what if I purchased it at a premium? So let's say I still get that $100, right? Because the par value is $1,000, my coupon rate's 10%, but I paid in $1,000, or $1,100 rather. In that case, I'm really getting a 9.1% return. And so the only thing you need to consider is, just because you have a par value of a certain amount, that isn't what you get in return. That's not your yield. You have to factor in, well, what did I actually pay to generate this interest or coupon, if you will? And those are some of the differences related to related to bonds. But essentially, bonds are just simply an IOU, right? I'm agreeing to pay you a certain amount of money in return. I want a series of coupons, and then I want a specified payment at the end of the maturity date.